Hi guys, Milad Rezai here, Director of Anchor Wealth. Today we're going to be talking to you about self-managed super funds, SMSFs as they are known. Now, high-level discussion today, and just a disclaimer at the start: this is none of this is a personal advice. It's basically for educational purposes only, and you need to seek a professional financial advisor and your other professionals to help you and to take into consideration your personal circumstances to make sure that the self-managed super fund is right for you. Having said that, now let's get into basically what a self-managed super fund is and how to go about setting one up. So a self-managed super fund can, with the recent legislation changes, can have up to 6 members now versus the 4 that it used to be. Now, with the 6 members, basically what you're getting is potentially now a full family, a family story there of 6 people, and that's usually the case. But predominantly in Australia, what you find is just the husband and the wife that would start the self-managed super fund. Now, with a self-managed super fund, you can go about it in two different ways. You can set up an individual trustee, or you can do what we refer to as a corporate trustee. Now, if you go down the path of an individual trustee, then all the members also are required to be the trustees of the self-managed super fund. If you decide you want to do the corporate trustee, then all the members are required to also be directors. So it does cost a bit more to set up the corporate trustee structure. However, in the long run, the admin side can become a lot less of a burden with changes that may be required. If you do decide to go individual trustee structure, there it can be a bit of a pain to make changes down the line to the actual the SMSF with members either entering or exiting the fund or other admin tasks that are required. So basically what the decision there is it worth to save a few $100s to go down the path of a trustee structure, individual trustee structure versus a corporate trustee, knowing that in the long run there could be big admin consequences with the individual trustee setup, and in most cases, the answer for that is a big no. So do talk to your accountant regarding that side of it, but it is important to note that as the first step. Now, the other important topic is what we refer to as a trust deed. Now, what is a trust deed? It's basically the rule book of the self-managed super fund. It's the backbone of the self-managed super fund. What can be done, what it can't do, the self-managed super fund, and basically what the self-managed super fund is trying to achieve. And it's actually pretty interesting that the trust deed can be more stringent than the SIS Act, basically making it more difficult and having its own extra layer of rules where the SIS Act may not. Now, we wouldn't recommend that for SMSFs, but if it's something that the trustees would like to do, then it's definitely available to do so. And all the trustees need to agree, or the directors need to agree on the trust deed, and it needs to be signed with what we refer to as a trustee declaration within 28 days of setting up the self-managed super fund. So this is a very important document and basically needs to be considered really closely. Now, the third thing we want to talk about is the investment strategy piece. Now, this is a very crucial another side of the self-managed super fund, because an investment strategy is basically why you are setting up your self-managed super fund in terms of the strategies. And it's not it's not enough to have a piece of document that says we're going to park 30% in Australian shares. It's not going to do the trick as far as the auditors are concerned. They need to see the why. So if you're going to put 100% of the funds into an investment property and make it a very illiquid fund, self-managed super fund, it needs to be pretty compelling. Not that it's going to be a decline or there's going to be any auditor issues, but there needs to be a clear why as to why you're doing it, understanding, and all the members or trustees need to be all over it. So that's an important thing to consider. And your financial planner is the person who will sit down with you, make sure the roadmap of the investment strategy is laid out pretty clearly, and it all goes back to the sole purpose test. So the sole purpose for a self-managed super fund is to provide retirement benefits to its members. And it's critical to understand that a lot of people think they're going to start a self-managed super fund and purchase a residential property inside the self-managed super fund and go and basically live in it, or to have a relative go in and become a tenant or make it their holiday house. It's not the case. There can't be any current benefits from your self-managed super fund investments. Now, there are some exceptions with the commercial property side, which again that will be discussed in another video. But it's just making sure you understand that there can't be any current benefits from your self-managed super funds. And this is where a lot of self-managed super fund members, trustees, or directors are getting caught out basically with audits. Is they are accessing the bank account associated with their self-managed super fund and paying for current expenses, or lending money to relatives and friends or family members. As you know, times can get tricky, and if there's a bank account sitting there that's not to be accessed, but it is accessible, then you can see why there has been some complications at audit times. So it's a big no as far as the ATO is concerned. So what are the two investment options that we regularly see Australians move to a self-managed super fund to have access to? One being residential property investing, in a sense that you can pool your funds together with other family members or your partner and go and borrow using a tool we call limited recourse borrowing arrangement and purchase a property. Again, it needs to be reflected in the investment strategy. The other one is commercial property investing. And a really high level example is, say you are a carpenter, or you're running your own factory. You can actually go and purchase that commercial property inside your self-managed super fund. Now, there's obviously a lot of rules around that, but this is again something that's not available to Australians inside of a regular super fund. Now, there's a lot of benefits also when it comes to the estate planning side for a self-managed super fund, and basically offers a lot more if it is more of a complicated situation in the family. So a lot of Australians do also choose a self-managed super fund for their estate planning benefits. So one of my biggest advice for Australians thinking about a self-managed super funds is don't do it on your own. Have a professional or a team of professionals that are in your corner, so you're getting everything right. Because if you don't, the penalties can be quite substantial. Now, the biggest tax consequence in Australia, or penalty, is actually to do with self-managed super funds, where almost half of your funds can be wiped out if you do get something wrong. A 45% tax penalty on the complete total balance. So is it worth saving a few $1,000s to basically to then later down the track potentially get something wrong and you are whacked with a big penalty like that, where half your funds are no longer there anymore? Absolutely not. So make sure you're getting the right team around you of financial planners, like an accountant, and potentially an administrative service to do all the work, in terms of the admin side, because there is a lot to get right. Now, how much funds do you need to actually start a self-managed super fund? Now, we would say $200,000 to $250,000 combined funds should make the self-managed super fund competitive in fees. What's important to consider is a lot of figures are thrown out in the industry, but it's a fixed cost when it comes to a self-managed super funds. So if you have $300,000 and you're paying $3,000 of fees, versus if you have $500,000 and you're paying $3,000 of fees, you can see how in relation to the $500,000, the $3,000 is a lower percentage. So that needs to be considered, versus in a regular super fund, you're paying a percentage based. So if you've got $1 million, you're still paying that. Maybe it's a 1.2% in annual fees. So a self-managed super fund may become a lot more cost effective as your balance grows. So again, you need to do your own number crunching, whether it's with your financial planner or your accountant, to make sure that it is the right suit for you. Now, if you're thinking self-managed super fund is interesting, it sounds like something that I'd like to consider, I want to find out a bit more about my options, you can actually click a link down the bottom, locking in and claiming your 30-minute free video strategy session with one of our advisors who will walk you through your options with the self-managed super funds and allow you to make an informed decision to make sure that you can weigh up whether a self-managed super fund is the right solution for you, considering your personal circumstances. Thank you for watching this video, and we'll be releasing more videos in the future. So again, press the subscribe button and you can keep updated with all things self-managed super fund and financial planning.